Today we're going to talk about some important tax stuff that you need to understand as a real estate professional, including your wage, HSA, IRA, SEP, FICA. HSA, SEP, IRA, Roth, FICA. What's all that stuff? What's all that stuff? Save yourself some money. Welcome to I Love Real Estate Stories, episode number 16. From the trenches. This is the show where we give you a behind-the-scenes look at the life of a real estate entrepreneur, showing you what's possible and teaching you along the way. It's summer here at I Love Real Estate Stories. Hey, last week we talked a little bit about the tale of two investors. The one investor that bought a Raptor to lower his tax liability. The other investor that invested in a SEP plan. So I actually just want to follow it up today and show you guys how you guys can self-direct. Talk a little bit about taxes, talk a little bit about self-directed IRAs, just so you guys have a better understanding of what that is, because I don't want you to be scared of it. Just because I lost money doesn't mean it's a bad investment. It's actually a good thing to do. I think anybody that wants to take control of their financial future should definitely do a self-directed IRA. So I want to talk a little bit today about that stuff. You guys go with that?
Hold on.
What?
Is this going to be super boring?
We're going to use the whiteboard.
Yay!
It will be boring. I'm not an accountant, so please don't take anything I'm going to say here as tax advice. But I want you guys to understand taxes, or how I understand taxes as a real estate entrepreneur, because you do need to understand them, because this is how your biggest expense is going to be taken from you, okay? So you need to understand some of these things. And I am going to use Form 1040, so you can follow along if you'd like, which is basically just the front page of your tax return. I'm going to show you how stuff flows through, because not only talking about some taxes and how you can limit your tax liability a little bit, we're also going to talk about self-directed IRAs and different accounts that you can use to get dollar-for-dollar deductions. Fair enough? I'm going to just show you what I do, but again, this is not tax advice. This is the way I understand it. Consult your own tax professional. There, we're done with all the disclaimer stuff, okay? Let's use this as an example. $100,000. You are a real estate professional. You're self-employed, and you're flipping houses, wholesaling houses, doing some active income, and you're making $100,000. So this is your $100,000. So is that your total income? Yes, but how did you take that income? Now it matters. Here's why. When you're talking about that Form 1040, the top line, or one of the top lines is called line 7, if you look there, and it's going to talk about wages. Now why does it matter? You're like, wages, I work for myself. I don't get a W-2 wage. You do. The IRS wants you to pay yourself a reasonable wage. And I'm going to show you why in a second. But a reasonable wage means flipping these houses, somebody had to manage that. And that somebody is you, presumably, okay? Somebody had to do that. So what's a reasonable part of that $100,000 that came from a wage? What could you reasonably pay someone to do that for you?
$1,000?
No, $1,000 is not reasonable. I would say, let's say for this example, $30,000, okay? So the company made $100,000 net profit flipping ones, but $30,000 of that was the wage to you, W-2 wage to you, to do that, because you ran your own company, right?
And all this is assuming that this person we're talking about, hypothetically, that made $100,000 in their company, doesn't have any employees, right? Or
yeah.
Okay. So this is the way you break it down, even if you're the only one.
Yeah, if you're the only one, right? Because you just flipped the property and got $100,000. The rest of this income is going to come under line 17, right? And this is just real estate rental properties or royalties from partnerships or S corps, which is what we're talking about here, comes here. So you've got the other $70,000 is coming here. Why does that matter to you? Because your total income is still $100,000 on that, right? So line 22 is going to say, what's your total income? And you're going to say $100,000. But right here, your $30,000 wage that you had to take, because you have to have a reasonable wage, has to pay FICA. A lot of people don't realize this. When you work for an employer, they pay for half of your Social Security, and you pay for half of it. And your Medicare, they pay for half of it, and you pay for half of it. Now, when you work for yourself, and you give yourself a wage, you're the employee, and you're also the employer. What does that mean to you? It means Social Security and Medicare. That's the stuff you have to pay for. That's the stuff you have to pay for. Right now, in 2015, sounds like fun, right? In 2015, you're gonna pay a total of 15.3% of that $30,000. And I don't have my calculator right here, but 15.3% of that $30,000 is, boom, going out to that FICA tax, okay? So that's why don't you want to pay yourself a $100,000 wage? Well, you'd be paying $15,000, right? You'd rather pay, what's a third of that? $5,000 instead of $15,000, okay? So you take the rest as just your real estate profits and your company profits, right? So that's why people reduce their reasonable wage because they don't want to pay this self-employment tax, or they don't want to pay more than they need to, or their fair share, okay? Line 22 is called your total income. This is your wage, some other things, your rental properties, and your partnerships and all stuff coming through. So this is your total income, $100,000, right? Before that, so right underneath that, you've got line 37, which is called AGI. AGI stands for adjusted gross income. So this is what you're going to be paying your federal and state taxes off of. In Utah, state taxes are 5%. So 5% of your AGI. Notice you've got total income and then you've got your AGI, right? So in between total income line 22 and AGI line 37, there's some things in there, okay? And you want to know what those things are, because that's going to reduce your $100,000 to some other figure, presumably lower, so you can pay less in federal and state taxes legally. Okay, it's a legal way to do it. Again, I'm not your tax professional, but this is just the way I understand it. Okay, you want to know what some of those things are between these two?
Does this involve offshore accounts?
No offshore accounts. Let's not do that. This is nothing that's illegal, okay? But between line 22 and line 37, I want to encourage you, I'm going to read some of them to you, but just check out this form right here. For your adjusted gross income, what are some of those things that are legitimate ways to reduce this down so you can pay less in federal and state taxes? Here's some of them, right? Educator expenses, health savings account deduction. What's that? Family and medical expenses. HSA stands for health savings account. Health savings account. I like to do self-directed accounts like you guys learned from last week, right? So if I have a health savings account, family and medical expenses, a family, like my family, you can pay $6,550 into your health savings account.
Regardless of your income? It's just like the max for everyone?
There's certain qualifications. You have to be like self-employed and pay your own thing. Yeah, there's certain qualifications.
But they have a cap on it, basically.
But that is the max that you can pay for your family to contribute, right? That reduces my AGI, okay? What else can we do there? Self-employed SEP, or simple qualified plans. Remember we talked about last week how I had a SEP? I set up, right? A SEP has to be 25% of your wage. Uh-oh, got more math going here. So in this example, $30,000, 25% of $30,000, what is that? I don't know. $7,500. Because that was 25% of my wage, okay? What else can we do here? Oh, IRA deduction. Line 32. IRA. Not the old man in your neighborhood IRA. This one stands for individual retirement account. The IRA deduction limit is $5,500. So you guys will see right here, our total income was $100,000, right? But before we got to our adjusted gross income, we got health savings account taken out. We got a SEP taken out. We got an IRA taken out. That's $19,550. So what's our adjusted gross income?
Nice.
So, okay. So now I get to pay my taxes. Now I get to pay federal and I get to pay state if you're in a state that has state taxes. So now what do I do with these accounts? I self-direct those accounts. So I'll take this amount of money. I self-direct all these accounts, even my health savings account. So I'll take this $19,550 and I'll go put it with a qualified custodian. So we talked about last week how I had a custodian who actually had their hand in the cookie jar and they did some things they shouldn't have done. But most custodians aren't like that. That doesn't happen a lot, right? So I take this money, I write a check to a custodian who's a third party, they hold the account for me, and then I direct them what I want them to do with that money. So although I cannot write a check now to fund a loan, I can tell my custodian, please write a check to fund that loan. They'll write a check to fund that loan. Now when the loan interest pays back, I get my principal plus interest, it pays back to my account, but the custodian is handling it, so it goes back there. I never touch the money from that point, but I get to enjoy the use of that and the growth of that money tax deferred, okay? Now there's also things too. This is to lower your tax liability. There's also accounts, IRAs like a Roth IRA. This IRA right here helped reduce my tax liability because it lowered my adjusted gross income. But sometimes people think, well, this is only growing tax deferred. I'm gonna have to pay taxes on that when I pull the money out. If you do a Roth IRA, you can have that same $5,500, but you do a Roth IRA down here. That $5,500 is after taxes. So if I say I wanna pay the tax and then fund the $5,500, that's even better because when I self-direct that, all of the growth that comes from that is tax-free. Does that make sense? So that's the advantage of a Roth, and that's extremely powerful. But today I just want to show you guys 3 ways to reduce your tax liability legally. Take money from one pocket, put it in another pocket, and be able to use it and self-direct it through a custodian. And that's powerful for real estate professionals. So hopefully you guys liked that. A little bit of a nerdy from the trenches, but this was stuff that took me years to kind of understand it. And hopefully you guys can understand it quicker and get running with these things.